Hey guys, it's about time I share my update for my $269,000 TFSA portfolio. For those of you that have followed my TFSA journey, you may be in for a complete shocker. Stay until the end to hear the reasoning for the massive changes I've made over the last few months. Let's do this! If you're new to the channel, I'm Mr. Financial with over 100,000 followers on Blossom Social. I'm into evidence-based investing using empirical data and studies. If that's your vibe, hit the subscribe button. I'd love to have you here with me. So, now for the big portfolio reveal. If you're one of the OGs on the channel, you know I used to own up to 20 or more dividend growth stocks in my TFSA. And as of my last update, I owned 11 dividend growth stocks. Over the last few months, I've sold every single one of my remaining holdings. That's Scotiabank, TC Energy Corp, Fortis, RioCan Real Estate Investment Trust, BCE Inc., Manulife Financial Corporation, Pembina, Enbridge, TELUS, Capital Power Corp, and Go Easy Ltd. It's pretty crazy, right? I've always held individual stocks to some extent, and this portfolio was built for dividend growth for when I go FI. If you've watched my interview with Momentum Finance, you already heard about the changes to my portfolio. If you haven't watched it already, go check out the interview right probably here. Stay until the end of the video for a brief breakdown why I made the surprising changes. So what did I buy? Broad-based index ETFs. As of right now, I have 7, but it's likely to be simplified as time goes on. Don't miss the end of this video where I'll share the reasoning for the changes I made. One thing I want to be clear on before I continue. Do not copy my portfolio. I have my own set of unique circumstances with my risk profile. The reason I'm sharing my portfolio is to inspire you to make a portfolio that suits your individual circumstances and your needs. So please do what's best for you, and if needed, seek the help of a fee-only financial planner. Now, this video is going to be a high-level overview of the ETFs I bought. In future videos, I'll be getting into the nitty-gritty of each ETF. So, my new largest holding is XEQT, iShares Core Equity ETF portfolio, also known as an all-in-one ETF. It represents 36.77% of my revamped portfolio. So why did I go with XEQT? I could have really gone with any of the EQT lineups by the big providers. It's splitting hairs between fees and construction at this point. The main reason I chose XEQT, besides the fact that I like to use other BlackRock products, is its lower home country bias at 25% Canadian. It is still substantially higher than the MSCI ACWI index, which sits at about 3%. That is eventually where I'd like to get my CAT exposure. XEQT is a fund of funds, for those that don't know, with its underlying ETFs being XIC, XTOT and iTOT, XEC, and XEF. This gives the ETF exposure to 8,450 stocks. The top 10 are different than the S&P 500 and only make up 17.4%, including 3 Canadian companies. XEQT uses a blended reference index, which is a composite of the S&P TSX capped composite index at 25%, the S&P total market index 45%, that's the US, the MSCI EAFE IMI index 25%, and the MSCI emerging markets IMI at 5%. That reference index is also the target weighting for Canadian, US, international developed market, and emerging market equities. XEQT also has a fairly reasonable MER at 0.20%, though it's not the lowest in the EQT lineup, which is sitting at around 0.17, 0.18% right now. My second largest holding is XTOT, iShares Core S&P Total US Stock Market Index ETF. It represents 20.91% of my portfolio. Why XTOT? XTOT holds just the US version, iTOT, the US S&P Total Market Index. XUU is the other messier option with many underlying holdings and a higher tracking error that I also hold. But XUU is turning into XTOT by holding iTOT as well. And XTOT is cheap with an MER of 0.7% and holds the entire US stock market, including large, mid, small, and micro-cap stocks. That totals 2,506 underlying holdings. Despite its massive number of holdings, this is a market cap weighted index, so the top 10 still account for, listen for it, 35.2% of the fund. That is something I'm very cognizant of and will add to the volatility of my portfolio as a whole, even with ETFs. Also, being a new ETF, it only has 2.1 billion in AUM compared to XUU's 4 billion. Though I don't think liquidity will be an issue with this ETF, as it is used in XEQT. This position is used to boost my US equities allocation. My third largest position is another all-in-one ETF, FEQT, Fidelity's all-in-one equity ETF. It represents 17.85% of my portfolio. This is a speculative and controversial holding for me because it's constructed very differently than all the other all-in-ones available in Canada, and it is also twice as expensive with an MER of 0.43%. It has 14 underlying funds, including a 3% allocation to Fidelity's Bitcoin ETF and Fidelity's Global Small Cap Opportunities Fund. The rest of the fund is constructed with a lot of thought. Canadian, US, and international equities are broken into 4 ETFs focused on 4 specific factors: value, momentum, high quality, and low volatility. FEQT's blended benchmark is 23.6% S&P TSX Composite Index, 47.3% Russell 1000 Index, 23.6% MSCI EAFE Index, 2.5% MSCI All World Country Small Cap Index, and a 3% Fidelity Bitcoin Index. Now, if the portfolio deviates from its neutral mix by greater than 5% between annual rebalances, the portfolio will be rebalanced beforehand. The only exception is with Bitcoin. If it becomes twice its neutral weight, or 6%, the allocation will be brought back to its neutral weight, with any proceeds being reallocated to the other underlying Fidelity ETFs at their approximate strategic allocations that we just discussed earlier. I'll be sharing in a later video why I'm using this product despite not liking the momentum factor exposure. At any rate, this is a bet to lower my portfolio volatility as a whole. And that's even with the momentum factor in there that increases the volatility slightly. My fourth position is FCAM, Fidelity All-American Equity ETF. It represents 12.29%. This is another controversial holding and adds a lot of complexity to my portfolio for a high MER cost of 0.43%. This is essentially the US equity portion of FEQT. It holds 4 underlying funds: Fidelity US Momentum, Value, High Quality, and Low Volatility ETFs. FCAM is a newer fund without a track record, giving it more risk of underperforming. You'll notice I don't share its total underlying holdings or its top 10. And the info for its PE ratios is taken from Morningstar's website, in case you are wondering. This fund does not have 5 years of history, so its standard deviation is just the category average, and no performance is shown. You'll notice this is also about half the size of my XTOT holding and has a very different sector breakdown compared to the total US market index. Something I really appreciate about FCAM is that it has a lot less exposure to giant market cap stocks and more to large, mid, and small cap. I'm using FCAM to augment my US allocation with the goal of less volatility. My next holding is XEF, iShares Core MSCI EAFE IMI Index ETF. It represents 5.14% of the portfolio. For those that aren't familiar with the index, EAFE IMI stands for Europe, Australasia, Far East Investable Market Index. It's a market cap weighted portfolio of nearly all stocks in the developed international market outside of where we live, North America. It currently has a modest MER at 0.22%. It holds 2,484 underlying holdings, with its top 10 accounting for only 10.5% of the fund. Geographically, it is heavy in Japan and the UK, but it is expected given the market cap weighting of the fund. Also, the sector breakdown is so different, vastly different from the US market that is dominated by tech. The EAFE area is heavy in financials, industrials, and as you can see, healthcare. This helps balance out the portfolio somewhat. The fund has a lower 5-year return compared to the US, as the US market has been the exceptional one the last 15 years. Nobody knows who will lead the markets in the future and where the EAFE market will be the next 15 years. So this position allows me to be positioned to capture whatever the market brings and be better aligned to the weighting of the MSCI ACWI index. My sixth position is FCIN, Fidelity All International Equity ETF. It makes up 4.86% of my portfolio. It is by far the most expensive product in the portfolio with an MER of 0.51%, 7 times more expensive than XTOT. Can you believe it? It also has a very high trading expense ratio at 0.21%. This means the fund really needs to perform well to make up for all this extra cost over XEF at 0.22%. So why do I include it as a small portion of the portfolio to boost my ex-North America allocation? FCIN is built exactly like FCAM with 4 underlying Fidelity single-factor ETFs: international value, momentum, low volatility, and high quality. And it's rebalanced like the others annually. It has a similar sector and geographic mix to XEF, but with exposure to a fraction of the total market. For example, FCIQ, the International High Quality ETF from Fidelity, makes up a quarter of FCIN. It only has 106 holdings. That's a fraction of the 2,484 of XEF. Time will tell if this bet on lowering the standard deviation of my portfolio works out or not. My last position is XEC, iShares Core MSCI Emerging Markets IMI Index ETF. This represents 2.63% of the portfolio, aimed at boosting my emerging market exposure, obviously. It is the most expensive pure market capital weighted index in the portfolio with an MER of 0.28%. XEC holds 3,040 underlying holdings directly, with its top 10 being quite heavy at 26.3% because of the large market cap sizes of Tencent Holdings and Taiwan Semiconductor. Logically, this also impacts its geographical diversification, with China and Taiwan making up nearly 50% of the fund. The emerging markets have been really underperforming the world markets over the last 15 years. However, this year, they're blowing the other markets out of the water. And this is why I like to be globally diversified. So that makes up my new TFSA, divided into 7 ETFs. This is what the geographic breakdown looks like as of November 30th. The US market makes up 57.4%. The EAFE markets make up 23.4%. Emerging markets make up 4.9%. The Canadian market makes up 13.9%. And BTC, Bitcoin, 0.5%. All from my FEQT position. What do you think about that allocation? And let me know your thoughts in the comments below. The benchmark for my portfolio is the MSCI ACWI IMI Index. Now, the question you are all likely thinking, why the jump from dividend growth stocks to broad market index ETFs with a little bit of factor tilts. It's pretty simple. I believe investing is like a beautiful Italian tailored suit. The style varies from person to person, but it also changes for the individual over time. The size, the color, the style one prefers. So for me, I'm going to be transitioning into a new season in my life and dealing with a differing tax law. My dividends would be all taxed at a very high rate, and my tax-free status in my TFSA would not be recognized. That means I don't want to have more income than I would need for my portfolio so as to not incur higher taxes each year, slowing down my compounding engine. Also, I still have 40 to 50 years, hopefully, of investing ahead of me. With this new season of life, I wanted more simplicity and consistency. The data and studies are crystal clear. I'd very likely work hard to underperform my benchmark substantially. I much rather spend the time with those I love, doing the things I love, and get better risk-adjusted returns along the way. It's a win-win for me. So that's the big portfolio update, everyone. I'm still a stock picker at heart and will be satisfying my itch with the little factor tilts I have in FCIN and FCAM. In any case, I'll be continuing to make more educational content on foundational topics on the channel, such as what are ETFs? You can check out that video right here. See you there.